Always great to see you. President Trump, different from other U.S. presidents, to put it mildly. Some are head-scratching at his policies here. What is your broad thought?
Well, he's using the tariffs to create tremendous uncertainty as to where the economy is going in the U.S. And we're seeing a significant slowdown in the U.S. economy, and you're seeing it in the stock market. As you pointed out, the NASDAQ is down 8% year to date, but off its high, it's down over 12%. So we're in corrective territory. And the S&P is well below its 200-day moving average, heading more towards the 10% correction level of about 5,500. That's what we're targeting. Yeah, we were a little surprised. Trump has always viewed his own personal report card as how the stock market is doing. He's trying to get away from that. We don't believe he actually will. At the end of the day, he's very much concerned about the stock market, but he seemed to indicate a recession and it might be coming. We don't see a recession, but certainly JP Morgan up their targets to 40% for recession probabilities. And so we won't ignore the fact that there's a lot of talk of recession, and we do see a slowdown. And we expect it over the next few weeks, maybe a month. Then we think it will start to straighten out a little bit as we get into the spring or early summer.
So you think that Trump and his team are worried about a falling stock market?
Absolutely. There's no question about it. They're all business people. How could you not be concerned about a falling stock market? I mean, look, the tariffs are one thing. That's just tremendous uncertainty. And given the nastiness as to how the tariffs have been presented, that certainly isn't helping. But the other things that are affecting the U.S. economy is we've really cut out immigration. So there's no new immigration coming into the borders, at least not like how it was. We're cutting back on government employees, which will cut back on government contractors. And we saw some real weakness in the unemployment number that a lot of people didn't seem to see last week. You know, the underemployment, the U6 went from 7.5% to 8%. That's a big drop, and we expect to see weakness in the JOLTS numbers tomorrow. Now, Fed Chair Powell seemed to indicate that he thinks the economy is just fine. We think he's going to end up eating those words because as the April and May employment numbers come out, we tend to think that he's going to have to start easing in May, not the June that is predicted right now. We still see 3 cuts for the year, but we haven't leaned towards 4 yet. But we definitely see Fed funds going down to 3.5% this year.
Oh, my goodness. So even a couple of weeks ago, it seemed there were fears, I don't know if that's the word, but a prediction that the Fed might not cut at all this year. But now you think 3 reductions are likely.
I think it's inevitable, the way that the volatility has increased and the way the uncertainty has increased, and that has caused corporations to cut back. I mean, even in today's business, you're supposed to have a dozen or so new issue corporates come to market today. I count 5, and I saw a story on Bloomberg that 10 have pulled their offerings. So that tells you that things are starting to be affected. And the corporate bond market was one of the last strongholds, and we still think it's okay, but nonetheless, we're very much concerned of the weakness. And whether there is a Trump put or not, there is a Fed put. I don't care who says what. There definitely is a Fed put, and we will see the Fed cut rates this year 3 times.
When you say a Fed push, just remind us, that means an expectation that if stocks drop enough, the Fed will step in with rate cuts?
I don't think the Fed would say as the stock market drops. I think that as the employment level drops. Remember, the Fed's got 2 mandates: employment, which is certainly higher in Powell's mind than inflation. I think inflation numbers are still sticky, but they're backward looking. And if you look at the recent Chinese numbers, they had the lowest inflation numbers that they've had, negative numbers, in something in the order of 15 years. So I think that there's a world deflationary problem coming. I think it's going to reduce inflation in the U.S. And I think the tariffs are really not an inflation aspect of a problem, but it's more of an uncertainty level of a problem. So the Fed will react to lowering employment or weak employment numbers.
So you see deflation, or at least deflation, as a possibility for the world?
I do. I think the slowdown will lead to deflation. I'm not talking about significant deflation. Look, you just looked at the price of oil. The price of oil has gone from the mid 70s, high 70s, down to 66. A lot of people that think it's going to go down to 60, and you quoted some speculator that thinks oil's going to drop dramatically. So, I mean, oil's a big part of the world's economies.
Yes.
So that's a big deflationary push. And so I think that a lot of the things that have been inflationary are no longer inflationary. You put the talk about eggs aside and the upticks in a few things in tariffs, but we really think that the world is slowing down. It'll continue to slow, even with the European defense spending, which we don't actually think is going to happen. But nonetheless, it certainly reflected in bunds, as well as we saw that JGBs, Japanese JGBs, 30 years are up to 260. I don't think I've seen that level in 15 years. And there's some speculating that U.S. rates may come down and German rates may actually go to parity. I don't see that either. But nonetheless, the 10-year bunds and 10-year treasuries have moved in 25 to 30 basis points in the last week. So we see a lot of turmoil, a lot of uncertainty, and that's going to weigh on economic activity.
We've only 30 seconds. Did you say you're a skeptic that Europe will really step up defense spending in a big way?
I see absolutely no chance that Europe will step up and do the defense spending as it was outlined by the incoming prime minister, or maybe he is the prime minister of Germany right now. I don't think he'll get the votes. I don't think he'll get the support. And I think that the Ukrainian-Russian war will be ended, and Germany will never actually end up putting 3.5% into GDP. That's just an opinion.
No, I understand. Sorry, but why? How do you think the war will end then, Andrew?
I think that Trump will continue to pressure Putin and continue to pressure Zelensky. You see it in the tape now. You know, Trump and Zelensky will sign some kind of mineral deal, and while it may not have an outward safety aspect to it, it will indicate that it will. There'll be some kind of negotiation. Putin will give up something. He'll get some territory. And, you know, no one wants the war. The Russians don't want the war. The Ukrainians don't want the war. No one in the world wants this war right now. So I tend to think it will end probably by the end of, I don't know, by the end of June, or maybe hopefully sooner.
Andrew, thank you very much indeed. Great hearing from you as ever. Andrew Brenner.